let's take a look at this. So when we look through these numbers, they put in $70,000. At the end of year 10, they have $77,291 in net cash value. Now, you don't have to stop. In fact, I would argue that stopping contributing at year 11 right here, you can see I have $0 for contract premium going in thereafter. While you don't have to stop making payments there, I put in this illustration that you're making no more payments. And the reason I put that you're making no more payments is just to show people that that is an option. That return, this 34.25 increase is effectively 45 times higher the return that you'd get in a normal emergency fund at a bank account. So think about that. Plus, in this instance, you actually wind up having this completely reduced and paid up, and it's guaranteed forever that your life insurance will be in place. So you have this fortress of financial stability in your emergency fund. You can use it for opportunity. Plus, you get the death benefit. Plus, if you become critically, chronically, or terminally ill, you get access to a portion of this full death benefit for complete leverage. Granted, in this instance, it's not that big of a pile of money. Hey, what's going on, Cashflow Hackers? It's Chris with Life 180, and for this video, I'm going to be talking to you about how there is no reason not to buy life insurance right now in this world. In fact, that's probably been the case for a long time, but the bottom line is there's a massive misunderstanding, misinterpretation about what life insurance is and how life insurance is sold. So think about it this way. When most people think about life insurance, they think about life insurance from the context of how much do I need to protect my family? And when I tell people and when I educate people about how life insurance really works, what the benefits are, not just when you die, but during your lifetime, they start to realize the value of life insurance, and it becomes not so much how much do I need, it's how much can I get? And ultimately, what I want to cover in this video is when you understand how life insurance really works, you get out of the conversation about, how do I get as little as I need, or how do I spend as little as I can to get as much life insurance as I need, I should say. Then it becomes how much money can I structure to get into one of these life insurance policies? How much am I able to get in there to get as much cash accumulation as possible in as quick a period of time? And so really, when you think about it, is I always like to take a step back and think about things as simplistically as possible, right? And so I'm always looking at this from the lens of, can I explain this to my 10-year-old daughter? That's kind of how I'm always looking at this thing. So I always, when you think about it that way, I take a step back and I say, okay, what is the purpose? What do I need this money to do for me? What do I need this asset to accomplish in my life? What does this asset need to do to accomplish my objectives? And so from that perspective, you need to start with the end in mind, and you need to figure out what are your objectives. And then you need to back your way into that. Now, what I know to be true is that when I talk to most people will acknowledge the fact that they need to have an emergency account, right? And now here's the crazy part. Most people will acknowledge that they need an emergency account, yet very few people actually have 6 to 12 months of emergency funds inside an account they have liquidity, use, and control of. A lot of people feel like they have their money in investment accounts. Maybe it's in a 401k, maybe it's in an IRA, and mentally and emotionally, they think they're okay because maybe they feel a little more insulated than they really are. Maybe they feel they're never going to be in a spot where they really need access to that much capital. Or maybe they think if they really need to, in case of emergency, break open glass, access that IRA, access that 401k, and they'll be just fine because they'll be able to either borrow against it or they'll be able to liquidate it depending on, what kind of account it's in. But the bottom line is this: that is the worst strategy possible, is leaning on investments for your emergency fund, because of the fact that what happens is typically, I should say, when you are in need of emergency funds, typically what's happening is the world around you is not quite in a good spot. I mean, unemployment rates go up and jobless rates, I suppose, and just when economic times of turmoil happen, right? When there's corrections in the marketplace. Now, obviously, anybody can lose their job at any point in time. Anybody can get sick at any point in time. There are bad things, unfortunate things that happen to everybody at some point in time in your life, and that is the point of the emergency fund. Now, the question is, where do you keep your emergency fund? And what I want to say is, if you're keeping your fund inside of a bank account, a savings account, checking account, CDs, anything of that nature that has a relative amount of liquidity to it, the purpose that you're keeping it there for is for the guarantees, is my guess, right? And so when you compare those types of financial vehicles to a life insurance product, then you realize that there's nothing nothing that a bank could offer, I should say, that is going to beat the returns of a properly designed, participating whole life insurance product. Now, what does that mean? I want to do this. I want to share my screen and get into this with you. All right, so when you look at a whole life insurance policy, a properly designed whole life insurance policy as a banking alternative, that is what I want to show you here. So when we talk about the fact that there's no reason for you to not have life insurance, that is simply because of the fact that every single person in this country needs to have an emergency fund. Now, I'm a big believer you actually need more than that, but for this conversation, let's just talk about it in the context of an emergency fund. Now, what does that look like? So I get kind of ridiculed on this channel sometimes saying that I do policies that are way too big, that the average American can't afford, so on and so forth. And so here's what I want to show you, utilizing numbers that I believe everybody should prioritize being able to accomplish. Now, so what does this look like? Anybody who's earning any kind of income as a household income above $60,000 should be able to pull this off, because this is less than 10,000 or 10% of their income. Now, what does this look like? I am using an example here of $5,000 per year being saved inside of an emergency fund, right? So this is, instead of you putting money into your savings account for an emergency fund, this is saying put it inside of a whole life insurance policy. Now, why would I do that? Well, let's take a look at the numbers. This is also showing that, assuming that you had $20,000 sitting inside of a bank account, right? Sitting inside of a savings account, earning like effectively 0.1% of interest, going on right now, losing money to purchasing power every single month and every single year, and going from there, right? Like, because 0.1% is under the target rate of inflation that the Federal Reserve puts into the economy. Now, I know that right now we're in a unique environment where inflation is extremely high. The volatility is crazy, and nobody knows where this is going to go. But the bottom line is, long-term inflation rates are between 2 and 3%. That is, the target is 2% for the Federal Reserve. And so whatever you utilize as a storage vehicle for your cash, for your liquid accessible cash, you need to make sure that that money long-term, because we have to be thinking long-term, is going to be earning better than inflation. And that's why I think whole life insurance is so powerful. It is a savings account on steroids. And it's so funny to me that people like Dave Ramsey are all about, you need an emergency fund, and then they like to rail on whole life insurance, and they don't realize that whole life insurance is the best place possible to keep your emergency fund. So here we go. This is saying, I'm using an example of somebody that had $20,000 already saved in a bank account, and they're trying to save. They're trying to annually accumulate more and more money towards their savings account. They're trying to meet that reserve. Let's say they're doing Dave Ramsey's baby steps, and they're saving that money, and they're trying to get there. Well, the bottom line is they take that $20,000 plus the $5,000 annual premium, and they save it into a whole life policy. Now, what does that look like? That looks like year one, they're going to have access to $22,624 right here, right? Now, that doesn't seem necessarily awesome, because you're losing access to $2,400 or so, right? $2,300 and change. You're losing access to that $2,000 and change, right? And so from that perspective, it doesn't sound very great. Year two, you're putting in $5,000, and the net cash value increase is $4,826. So it's going up. You put in $5,000, the account value went up by 100, or by less than, I guess you lost liquidity of $174, right, of that money, or 100, yeah, something like that, 174. And so in that scenario, once again, people are like, but once again, you have to think long-term in this scenario. You've put in 30,000, you have liquidity of 27,450. But here's the deal. You also have $400,000 of life insurance. Now you started off with 423, but what happens? And this is the other thing. Dave Ramsey's always saying, you don't get the cash value, you only get the death benefit, right? They take your cash value when you die. But look what's happening. I'm putting 5,000 in, right? And the death benefit went from 423 to 431. The death benefit's increasing. Why is the death benefit increasing? Because if I have my money going into the account and I structure it right, my death benefit is going to increase with the cash value. Why do they do that? Because if you save your money in a savings account, that money winds up being taxed. If I put it inside of a whole life policy and they pay it as a savings account, it's going to be taxed. But if they just say, okay, we're going to hold that and we're just going to increase your death benefit to go with it, well, then it gets paid in the tax advantaged way, right? And you can see that the death benefit goes up and up and up and up. It starts at 423 and it goes to 513. The cash value grows and it's pretty straightforward. Now, here's why I love this. Let's just say for this family, they make $75,000 or $80,000 a year for household income, and they're saving the $5,000 a year, which is, by the way, under 10% of their income to be able to save. So this is going to put them in a position where they have their emergency fund more than met. Plus, they're going to have some opportunity fund built into this. So if they come across a real estate opportunity, if they come across any other kind of opportunity in the marketplace, they're going to be able to capitalize on it once they hit at least half of this number, let's say, right? And so let's take a look at this. So when we look through these numbers, they put in $70,000. At the end of year 10, they have $77,291 in net cash value. Now, you don't have to stop. In fact, I would argue that stopping contributing at year 11 right here, you can see I have $0 for contract premium going in thereafter. While you don't have to stop making payments there, I put in this illustration that you're making no more payments. And the reason I put that you're making no more payments is just to show people that that is an option. You can do what's called reduce paid up. And what will happen is you reduce the insurance. And so you could see the insurance drops from 513 to 161,000, but the cash value keeps growing. And you can see that you have 77,291. You didn't make any payments, but between the dividend right here and the guarantees, your net cash value increase went up by 3,425. Now, a little math here goes to show that I have, let me do some quick math, and I go 3,425 divided by the 77,291. And that's a 4.5% return that year alone. So that return, this 3,425 increase is effectively 45 times higher the return that you'd get in a normal emergency fund at a bank account. So think about that. Plus, in this instance, you actually wind up having this completely reduced and paid up, and it's guaranteed forever that your life insurance will be in place. So you have this fortress of financial stability in your emergency fund. You can use it for opportunity. Plus, you get the death benefit. Plus, if you become critically, chronically, or terminally ill, you get access to a portion of this full death benefit for complete leverage. Granted, in this instance, it's not that big of a pile of money because we're dealing with smaller numbers. If you're somebody who's got more money, if you're somebody that wants to contribute more, if you're somebody who's into real estate investing and you want to be able to get more capital in here to be able to capitalize on real estate, by the way, that's why I wrote this book, Cash Flow Hacking, to teach people how to do that. Go check that out. There's a link in the description below, but that is all right here. So what I would say when I say there is no reason to not buy life insurance, it's because of the fact that every single person needs to have an emergency fund. The biggest mistake that people make in this world is they structure their financial lives improperly. I made that mistake when I was younger. I know a lot of people make that mistake where they go out and they invest before they save. And so my mindset and what I teach people is that you need to invest, or you need to save before you invest, but you need to save with the intent to invest. Because if you go out and you invest too soon, you take on too much risk, and then when the market volatility hits and you don't have enough savings and the foundation of your financial life is not there, what happens is you end up having a compound the problems by liquidating negatively performing assets, by not having your emergency account or using the wrong type of accounts, investment accounts for your emergency funds, then that puts you in a situation where you are ultimately going to fail. And the facts are, if you are saving for retirement, so to speak, for a 40-year period, you're going to have 5 or so boom bust cycles during that period of time. And it only takes 1 or 2 of those to happen where you are not designed or structured properly with your financial setup, and that will impact your ability to achieve your financial goals. And so by following this plan, by implementing and saving your emergency fund and what I would consider to be an opportunity fund, that's why I would keep this going even higher than what I'm showing you, but I just want to talk about an emergency fund in this video. It's really hard for me to just stick on that, by the way. By doing that, you are setting yourself up for complete success and putting yourself in a position where you can thrive in any economy, which is extremely, extremely important, especially with what I feel is coming down the pipeline right now. If you haven't looked at this in your own life, it looks a little differently for everybody. There's no doubt about that. But if you want to get a free, no pressure consultation about what this could look like for you and your life, go ahead, click on the link in the description below, and you can get on the phone with one of our endorsed Life 180 representatives, and they can walk you through a process and guide you and coach you and answer any questions that you have in regards to your personal finances. So anyway, I hope that helps. I hope you found value. If you did, make sure you hit that subscribe button, click the bell. That way you get notified every time I launch a new video. And as always, have a blessed, inspirational day. We'll talk soon. See ya.